21.4b. This is our first entry, or our first exercise rather, that deals with the issue of a lessor. And specifically, this is going to be classified as a direct financing lease, as we'll see in a second. So, terms of the facts of the problem are: we've got Power Top Leasing. They are the lessor. They signed a lease agreement on January 1st, 2014 to lease some power equipment to the lessee, who is Manual Bottoms Company. The term of the lease is for 4 years, so it's a 4-year term, and payments are required at the end of each year. The significance of that is it tells us in present value calculations we're looking at a present value of an ordinary annuity. We're told that the company, Manual Bottoms, has the option to purchase the equipment for $25,000 upon the termination of the lease. Now, the significance of that is if that $25,000 is below the fair value of the property at the termination of the lease, then that $25,000 is to be characterized as a bargain purchase option, and that's going to have a couple of impacts. One impact is it would be a component of the minimum lease payments, and the second impact is it would require us to say yes to that question, the 4-part test, as to whether or not there's a bargain purchase option, and it would therefore trigger the lease being characterized as a capital lease. But we don't yet know whether that $25,000 purchase option is going to be classified as a bargain purchase option until we know what the fair value of the property is. So when we get to fact 2 here, we see that the equipment has a cost and a fair value to the lessor of $325,000. $325,000 equals cost equals fair market value of the property to the lessor. That's significant because if this is classified as a capital lease, it's going to be classified as a direct financing lease because there's no dealer profit. Dealer profit would be present if the fair market value of the property was greater than the cost of the property to the lessor. In this case, since they're not, since they are equal, if this is a capital lease, it's going to be considered to be a direct financing lease from the point of view of the lessor. Now, we're told here that the useful life of the property is 5 years. Okay. And the property at the end of the lease term is going to have a salvage value of $25,000. Okay. So since the salvage value or the fair value of the property at the end of the lease term is $25,000, and since the purchase option is $25,000, what we know now is that that $25,000 purchase option is not a bargain purchase option. Since it is not a bargain purchase option, we can essentially ignore it whenever we do the present value of the minimum lease payment calculations, because it's not going to be considered a component of minimum lease payments, because it's not bargain purchase. It's an option to purchase the equipment at fair market value. Okay. So the lessee here, who is Manuel Bottom's company, has to pay $2,000 each year to the lessor for executory costs. And we're told here that the lessor desires to earn a return of 12% on its lease. So the lessor is going to set its lease payments so that it is able to earn a 12% return. Finally, we're told here that the collectability of the payments by the lessor's ability to collect these payments is reasonably assured, and there are no important uncertainties surrounding the cost to be incurred by the lessor. In other words, the lessor, upon inking the contract, is done essentially everything that he is required to do in connection with this lease. Okay, so I'm going to clean out some space here. And then we'll continue with the analysis of the problem. Okay, first thing we're asked to do here is prepare the journal entries on the books of the lessor to reflect the lease. Basically book the lease and the accounting records of the lessor. So, first thing we got to do is we got to figure out how much this lessor is going to charge the lessee under the terms of this lease. We're not told explicitly what the lease payments are. All we're told is information about what the value of the equipment is worth today, what the value of the equipment is worth at the end of the lease term, and what rate of return the lessor wants to earn. So with all of that information, we're able to calculate what lease payment the lessor is going to demand of the lessee. And here's the way we do it. First, we're going to look at what the fair value of the equipment is today. The facts of the problem tell us it's $325,000. Then we're going to look at what the fair value of the equipment is forecasted to be at the end of the lease term. At the end of the lease term, that equipment is forecasted to have a value of $25,000 according to the facts of the problem. So what we need to do is we need to take that $25,000, which is the value of the property at the end of the lease term, 4 years from now, and we need to discount it back to the present to get a present value number. And we're going to do that by multiplying the residual value of the property at the end of the lease term by a present value of the single sum factor, where the discount period is for 4 years because it's a 4-year lease term. And the 12% rate here that we're going to use in the discounting process is the rate of return that the lessor wants to earn on its lease. So you either use your present value calculator or you flip to the tables in the textbook and you find that the present value of the single sum factor, I is equal to 12%, n is equal to 4, that's 0.6355. Multiply the 0.6355 times the $25,000 residual value at the end of the lease term, and what you have is the present value of the residual value. Okay, so here's what the lessor is going to do. He's going to say, well, the value of the equipment today is $325,000. The value today of the residual value that I'm going to get back at the end of the lease term, that's $15,887.50. So the difference between those two is what I must recoup from the lessee in present value terms as lease payments over the life of this lease. If I do that, then that's going to let me earn my desired rate of return is 12%. So the question is, what lease payment will yield a present value equal to this $309,112.50? So the way we're going to determine that is we're going to set up a little equation. We're going to take the present value of an ordinary annuity factor. I is equal to 12%. That's the desired rate of return by the lessor on this lease. And again, this is an ordinary annuity because the lease payment occurs at the end of each year. I believe that's right, isn't it? Payments are required at the end of the year, yeah. So present value of an ordinary annuity factor, 12% discount rate, n is equal to 4 because there's 4 payments. Take that factor, multiply it times some unknown payment amount, that's what we're trying to determine, and set that equal to the amount that we have to recoup from the lessee in present value terms, which is $309,112.50. So you plug the present value annuity factor in from the table 3.0373, multiply that times some unknown payment amount and set it equal to $309,112.50. Or rearrange algebraically, solve for the payment, and the payment amount that you have to charge on this lease is $101,772.13. If you charge $101,772.13 lease payment, 4 of those discounted back to the present at a 12% interest rate is going to yield a present value of $309,112.50. So that's the payment amount. So when you see these lease problems and they explicitly tell you what the lease payment is, implicitly that's the process that the lessor went through in order to determine the lease payment amount. Okay, so now what we've got to do is we've got to figure out whether this is a capital lease or an operating lease by applying the 4-part test. So the first question of the 4-part test is there bargain purchase option? Well, we determined that there is a purchase option, but it's not a bargain purchase option because it does not give the lessee the right to buy the property at the end of the lease term at less than fair market value. Does the lease, so the answer is no. Does title transfer to the lessee at any time during the lease? Answer is no. Okay. What about the lease term of the lease term relative to the economic life of the asset? Is the lease term at least 75% of the economic life of the asset? Well, the answer to that question is yes. The lease term is 4 years. The economic life of the asset is 5 years. So the lease spans 80% of the economic life of the asset. So based upon that, we come to the tentative conclusion that this is going to be a capital lease. The reason I say tentative conclusion is because when you're accounting for the lease from the point of view of the lessor, there are 2 additional questions that you have to ask if you answer yes to one of the 4 questions in the 4-part test. The additional question you have to ask is the collectibility of these rental payments reasonably assured, and is the lessor's performance substantially complete under the terms of the lease? And normally the way that question is answered is to ask whether or not there's any significant uncertainty about additional cost to be incurred by the lessor rather. In this case, we're told that there's no uncertainty about additional cost to be performed by the lessor. So in fact, the answer to both of these questions is yes. Collectibility is reasonably assured. Lessor's performance is substantially complete. So since we answered yes to one of these 4-part questions, and we answered yes to both of these additional questions that apply only to lessors, our final conclusion is this is in fact a capital lease. And a particular type of capital lease, this is the next question that we have to ask. We've already answered it, but we'll go over it again. A capital lease can either be a direct financing lease or a sales type lease. from the point of view of the lessor. A lease that has dealer's profit is considered a sales type lease. A lease without dealer's profit is considered a direct financing lease. This lease is considered a direct financing lease because there's no dealer's profit, meaning the cost of the asset or the book value of the asset in the lessor's accounting records is equal to the fair market value of the leased asset. So we've got a direct financing lease here that we've got to account for. Okay, so the next thing we need to do is we need to calculate the present value of the minimum lease payments. The present value of the minimum lease payments is 309,112.5. And the way you calculate that is you take the payment amount of 101,772.13 and multiply it times present value of an ordinary annuity factor where n is equal to 4 and interest is equal to 12%. Well, that present value of the annuity factor we already determined to be 3.0373. We take the 3.0373 and we multiply it times the 101,772.13 and we come up with 309,112.50. No big surprise because we already determined that up there. So present value of minimum lease payments 309,112.5. There is no guaranteed residual value to calculate the present value of, so that's 0. There is no bargain purchase option to calculate the present value of, that's 0. There is no present value of non-renewal penalty, that's 0. So total present value of minimum lease payments 309,112.5. And that is in fact in excess of 90% of the fair value of the asset. So even if we hadn't passed the 75% of the economic life of asset test, triggering recognition of this as a capital lease, we would have passed the 95% of fair market value test. So that would have triggered recognition of this as a capital lease. Okay, now if you'll recall from our class discussion, in a direct financing lease, as well as in a sales type lease, the lease receivable is debited in the accounting records of the lessor in an amount equal to the present value of the minimum lease payments plus the present value of unguaranteed residual value. The present value of the minimum lease payments is 309,112.5. The present value of the unguaranteed residual value is 15,887.50. So the total amount that we're going to debit the lease receivable account for here is the sum of the present value minimum lease payments plus the present value of the unguaranteed residual value. So debit lease receivable for $325,000 and credit the equipment account for its carrying amount in the accounting records of the lessor, which according to the facts of the problem is $325,000. That's the entry that the lessor is going to make on 1/1/14, the day that they entered into the lease agreement to record the capital lease. Okay, time marches on. Let me clear out some space here. So time marches on. We're standing here now at December 31st, 2014. the lessee is going to make its first payment to the lessor, and the amount of the payment is going to consist of two components. It's going to consist of the payment of 101,772.13, which is the recurring rental payment, plus the executory cost of $2,000 that the facts of the problem tell us up here that the lessee pays to the lessor. So the amount of the check the lessor is going to get is going to be this 101,772.13 plus $2,000. So the lessor, that's of course 103,272.13. The lessor is going to go to the mailbox on 12/31/2014 and find a check for 103,772.13 and debit cash for that amount. Now, out of that 103,772.13, 2,000 of that is for executory cost. So those are costs that the lessor is going to be paying pertaining to the ownership of this leased asset. Things like taxes or insurance or whatever. Assuming that the lessor has not yet paid those costs, but those costs will be paid in the foreseeable future, we're going to take 2,000 of the 103,772.13 and credit that to an executory cost payable. And so then sometimes shortly after December 31st, 2014, when the lessor pays the property taxes or the insurance or whatever that is, they're going to debit the executory cost payable account and they're going to credit cash. But since we're assuming here that the executory costs have not yet been paid, we're going to set that $2,000 payment for executory cost up in a liability account, reflecting the fact that the lessor has to, in the near future, remit those payments. Okay, so now we got to figure out how much of the remaining portion of the payment, 101,772.13, how much of that is interest, how much of that is principal. And of course, we're going to do it the way we've done it all along. To calculate the portion that's interest, we're going to take the carrying amount of the obligation at the beginning. In this case, it's not an obligation, it's a receivable. The carrying amount of the lessor's receivable from the lessee at the beginning of the interest period. The beginning of the interest period, of course, is just January 1st, 2014. That is the amount that we debited the lease receivable account for. And we're going to debit that, and we're going to multiply that times the interest rate that is implicit in this lending agreement from the point of view of the lessor, which is 12%. So we take 325,000 times 12%. That gives us 39,000. What that tells us is out of the 101,772.13 payment, that is the payment net of executory cost, 39,000 of that is going to be characterized as attributable to interest that is accrued on that receivable over the course of the year, and the remaining portion of 62,772.13 is going to be deemed as a payment of principal, which is going to serve to reduce the lease receivable account. So the entry, debit cash for the full cash received by the lessor, credit executory payable for cash that the lessor received from the lessee that is attributable to executory costs that the lessor has to pay on behalf of the lessee, credit interest revenue for 39,000, the portion of the interest that is accrued on this lease receivable, and reduce lease receivable by credit for the portion of the payment that is deemed to be a payment of principal. Okay, so that's the entry that's going to take place on December 31st, 2014. So time marches on. Here we are at December 31st, 2015. The lessor goes back to the mailbox on December 31st, 2015, and gets the second lease payment from the lessee. That payment amount is same as it was last year, $103,772.13. Out of that $103,772.13 is a payment for executory cost, which, assuming that the executory costs have not yet been paid by the lessor, and that the lessor will pay those executory costs in the foreseeable future, we're going to set that $2,000 payment up as a executory cost payable account. And then the remaining portion of the payment, the $101,772.13, we're going to portion between interest and principal, just as we did 12 months ago in connection with the first payment. So to determine how much of the payment is characterized as interest revenue, we're going to take the carrying amount of the lease receivable at the beginning of the interest period. The beginning of the interest period is 1/1/2015. The balance of the lease receivable account at January 1st, 2015 is $325, the initial lease receivable amount, less the debit to the lease receivable, the credit to the lease receivable account we made in connection with the first lease payment on December 31st, 2014. That net amount is going to be $262,227.87. We're going to take that amount, multiply it times 12%, and the result of that calculation is going to give us $31,467.34. That's the amount of the second lease payment that's going to be characterized as interest revenue. And the remaining portion of the payment is going to be deemed as a principal payment, which serves to reduce the lease receivable account. So the entry then to record the payment, second lease payment, is here. Debit cash for the cash received, credit executory costs payable for $2,000, credit interest revenue for the portion of the payment that is deemed to be interest, and credit lease receivable for the amount of the payment that is deemed to be principal. All right, so that takes care of part A and part A of the problem. Part B of the problem here asks us to prepare the entry. This should be, I believe, 2018. I think there was a mistake. Yeah, December 31st, 2018. So we're asked to prepare the journal entry at December 31st, 2018 to reflect the sale of that leased asset to the lessee at the stipulated purchase price of $25,000. Remember, there's a purchase option that gives the lessee the right to buy the property at the end of the lease term for $25,000. And so we're asked to prepare the journal entry related to that. To do that, what you really have to do is you have to set up an amortization schedule that amortizes this the lease payments out over the lease term. So like any amortization schedule, you set up the carrying amount of the obligation here at the beginning of the period. That came from, let me clear out some space up here so you can track these numbers through. That came from this first journal entry here. That's the amount we booked the obligation at. And then our first payment, net of executory cost, took place on December 31st, 2014. Out of that payment, we calculated that $39,000 was interest, and we said that the other $62,770 $62,772.13 was principal. That yielded an ending balance of the lease receivable at close of business 12/31/2014 of $262,227.87. Then, oh, wait. That should be 2015, that should be 2016, that should be 2017. So I was wrong when I said that the date up here was wrong. I thought it was wrong because I goofed up on my amortization schedule. Actually, the date is December 31st, 2017. So again, this should be 12/31/2015, this should be 12/31/2016, this should be 12/31/2017. Okay, so the second payment on December 31st, 2015, the payment is $101,772.10. We already determined that the portion of that payment that is deemed to be interest is $31,467.34. The portion that's deemed to be principal is deemed to be $70,304.79. So the ending balance of the receivable close of business December 31st, 2016 was $191,923.04. Okay, let me clear out a little bit more space and we'll continue. Okay, so then the third lease payment that takes place on December 31st, 2016, the payment amount $101,772.10 is split between the interest and principal. There's the portion that's interest, there's the portion that's principal. So the balance here is equal to the balance at the beginning of the interest period less the portion that was deemed to be principal payment, $78,741.30. Was at 36. Difference between those two is just the $181.75. And finally, the last interest payment or the last rental payment takes place on December 31st, 2017. The payment is $101,772.10. The split between interest and principal appears here. And so what we have is a balance in the lease receivable payment, close of business, December 31st, 2017, equal to $24,991.40. Okay, again, that's the balance on the lessor's records of the lease receivable account immediately after the last lease payment occurs. So immediately after the last lease payment occurs, what's going to happen is the lessee decides to exercise their purchase option. They pick up the phone, they call the lessor, hey lessor, pursuant to our lease agreement, we want to buy this piece of equipment from you that we've been leasing for $25,000. So they send the lessor a check. The lessor records that receipt of cash, debit cash $25,000. They remove the lease receivable account from their books here by crediting the lease receivable account for its current balance of $24,991.04, and then they recognize gain on sale equal to the excess of the cash received over the carrying amount of the receivable, $8.60. Now let me point out to you that in this case the balance of the lease receivable account, $24,991.15, at close of business 12/31/2017. That really was due to a rounding difference. On a direct financing lease, the balance of the lease receivable at the end of the lease term should equal what the initial estimated residual value of the asset was. It didn't in this case, because we had some slight rounding errors in connection with our present value calculations. But had these calculations been carried out, with more decimal points than what we actually did, this balance here would have been $25,000, And the entry would have been simply debit cash $25,000, credit lease receivable $25,000.